economy of tomorrow. Today, I would like to introduce you to the golden economic indicator that accurately identified and even predicted the recent financial crisis and economic recession. So let's go. Stock market leads economic growth or decline. In other words, usually GDP growth is preceded by a stock market rally and a recession is followed by a 20% or more stock market drop. When the economy contracts, the prices of stocks, goods and services drop. As you can see, the nominal price of S&P 500, the biggest US stock index, peaked in 2007. However, S&P stocks priced in terms of gold ounces actually peaked in 2000, as shown by the pink line. The pink line tells you how many ounces of gold could buy one S&P contract. As you can see, the price of S&P in gold ounces has plummeted from 5.5 ounces in 2000 to less than 1 ounce today. Can you guess what else peaked in 2000? It's employment, as shown by the green line. It shows you that the proportion of the working population to the total US population has been falling for nearly 12 years, despite the fact that the financial crisis only began in 2007. So why does it matter? This means that the prices of stocks measured in ounces of gold have been trying to tell us that we were in trouble long before the financial crisis hit us in 2008. If you think that the matching peaks in employment and real stock prices is just an amazing coincidence, then hold your breath. This slide shows you that the entire household wealth measured in gold ounces also peaked in 2000. In fact, that the US household wealth has lost 75% of its value since 2000, and now is at the same level today as it was 27 years ago, despite the fact that the population has grown by 15% since then. What does it all mean? It means that simply by using the gold price, you could have stayed ahead of the crowd in anticipating the recent financial crisis and recession. You could do this by looking at the prices of commodities as well, priced in gold, of course. For example, the blue line on this chart is CRB Jeffries, the index of 19 most important commodities in the world, including cattle, wheat, orange juice, coffee, etc. As you can see, the real commodity prices, priced in terms of gold ounces, peaked in early 2001, just a few months after the real stocks had peaked. Employment had peaked, and the US household wealth had peaked. Economists called the 2001-2002 recession just a little blip in the economy. And there was a recovery, but as you can see from the chart, it didn't make a new high in 2006. And the real estate also peaked in 2006. In the US, and the economy has been in a free fall ever since. But they only noticed it in 2008, when the trend was unmistakable. Again, if you were looking at things in terms of gold ounces, you would have known about the downtrend long before. People heard about it on the media. And the incredible value of using gold in analysis doesn't end here. For example, US government economists announced that the recession was over in mid-2009. However, the house prices made a new low in 2010 and then in 2011. And the employment to population ratio, as you've seen earlier, also made a new low in 2012. All of this happened while the commodity prices in aggregate also fell to an all-time low. They keep telling you that the recession is over, but this chart has a completely different message. What if they are completely wrong and that the recession did not end in 2009 and in fact still continues? Why has gold been so accurate in identifying and even predicting the recent economic recessions? Is it because the market thinks gold is real money? Or is there something else to it? What do you guys think?